Fundstrat's head of research, Tom Lee, and Wolfe Research chief investment strategist, Chris Senyek. Good to have you both here. Tom, put this in some context here in terms of we have had an attempt at a market bottom last October. Kind of a middling performance in that regard, I guess, if you thought it was a new bull market. And now we have this macro stress. We have this Fed meeting. How does it filter into your view?
Well, I mean, this latest regional bank crisis and CS is really just another piece of the Fed's policy sort of biting, and it's creating more stresses. I think it is making investors really cautious, and it's understandable because as long as rates are rising and we have inflation as a problem, it means there could be further fractures in the financial system, whether it's CNBC or regional banks. But I think similar to '08, you still could find places to find relative safety. Because, even if you were thinking this is the GFC again, from October '08 through March '09, you did find owning technology, owning FANG, even owning some energy. And I think that's the case now. I think the market's revealing parts of this economy are relatively unscathed. And I'd say maybe sticking with tech and FANG is a way to sort of wait it out.
Even after this little the GFC, sorry.
Yeah.
Nobody does think this is '08, though, Tom.
Yeah,
Unless you do.
I don't. But what we have to appreciate is that in the fixed income world, especially because of the move in volatility and drop in liquidity, it's probably been like a GFC event in the credit markets. I think that we saw last week a lot of large macro funds experience drawdowns that only happen in systematic-like events. So I think in credit, there was something pretty big that happened. I think equity's been unscathed, and that's been a good thing so far.
Yeah, in credit, in performance-based quant strategies, not in the core banks, at least not at this point. And Tom, you still think that there are shoes to drop here, whether it's the effect on earnings, where it's going to drag the S&P to. Bring us up to date on your view.
Chris.
Oh, Chris, I'm sorry. Apologies.
No worries. Thanks for having me on. We're bearish. We've been bearish for the last 14 months, and the Fed really, in our minds, has no good options, right? I mean, I think they'll hike 25 basis points with some hedging language around that, but inflation continues to run hot and sticky, and even if the Fed ends up pausing at this meeting or in future meetings, they might have to restart again. And so I think it's an environment that we haven't seen in a long, long time. Meanwhile, the S&P is trading at 17 times forward earnings that we think are way too high. Our earnings estimate for this year is 190, and we step back and think about the events over the last 2 weeks and what it means. The biggest loser is tech, we think, because tech spending is going to come under a lot of pressure. Don't forget that financial services firms are among the largest, if not the largest, buyers of tech equipment, and I think they're going to pause here.
That's an interesting view, just on the fundamentals of tech not being that appealing. I was just going to throw at it, Tom, that when you say tech, you really have to distinguish if you're talking about good balance sheet tech companies or unprofitable tech companies, which all rallied hard last week. But if we're going into a deep recession, is that really where you want to be?
Well, and that's the if
recession
part, yeah. So I think it's the if or even big, because I'd say at the end of the day, technology has a bigger end market addressing wage pressures. I mean, if you got a concern about wage inflation, automation and tech delivering productivity solutions is sort of the way out of that. And I think we just have to be mindful. The Fed, is in a tricky spot, but if inflation is slowing, which it is, I mean, it's not wrong if the Fed pauses here, and I think doesn't mean that we have to see further drawdowns in equity. So I think we're in a tricky spot, but it could be quite positive.
Yeah, Chris, don't fight the Fed has been kind of an effective rule, except, the Fed's done a lot in the last 10 months and the S&P hasn't really gone anywhere on a net basis. Do you think that that's showing resilience, or are there just parts of this market that are going to give way?
Well, there's a lot of mixed messages, right? I think the bond market is signaling one thing. Look at the move index of Treasury volatility, and that's off the charts. And these daily moves we're seeing in 2-year Treasuries, among others, have been fairly epic, something we haven't seen since the GFC or even, Black Monday. And I think the equity market, meanwhile, has been relatively resilient because we haven't seen it in the numbers, right? We haven't seen number revisions really for earnings come down meaningfully. There's a big dichotomy between the soft data and the survey data and the hard data. And we think as these credit conditions tighten, which we think they're going to happen across the board, that we're going to start to see in the hard data. And when we see in the hard data, and then when companies come out this earnings season, sound more cautious and give more cautious guidance, that's when I think it'll hit stocks. I think stocks are just in a little bit of fairy tale land right now.
Yeah, well, it's certainly been some delays. We thought that might have been the story of the first quarter this year, those downgrades of earnings expectations. We'll see if it does hit, though. Tom and Chris, appreciate the time today. Thank you.
Thank you.
Just want to hit a headline.